Hi everyone, welcome back to my channel Commerce Student. I hope all of you are fine. Today I am back with part 2 of our basic accounting terms. In case you missed part 1, I have provided the link in the description. You can watch it from there. Now let's start today's video. Let's start with purchases. In simple terms, purchases are the total goods a business gets to sell or use in making other products or services. When we say to sell, it implies purchase of finished goods, which is common in trading businesses, where buy and sell occur. And when we say to use in making other products or services, it implies purchase of raw materials, which is common in case of manufacturing businesses. Purchases can happen through cash or credit. Remember one thing, that we are talking about goods, not assets in case with purchases. Sales. Sales are also related with goods. Sales refer to the money earned from selling goods or providing services, whether it is a cash transaction or on credit. So it is straightforward, that is what you earn from selling. Purchases return or returns outward. When some of the goods purchased are sent back to the seller because of some reasons, maybe they were defective, damaged, or not up to standard, such return of goods is called purchases return. To calculate the amount of net purchases made, we deduct these returns from the total purchases. So think of it like a goods come, goods go situation. Purchases return is also called returns outward. Why? Because the goods are going out from the business to the seller. Sales return or returns inward. It is the opposite of purchases return. Here the business receives back the goods sold to customers, and those goods are sales returns itself. This happens maybe due to excess, unspecified, or defective goods. To calculate the amount of net sales, we deduct the sales returns from the total sales. So think of it like a goods go, goods come situation. Sales return is also called returns inward. Why? Because the goods are coming back in the business from the customers. Let me provide you with an example to further understand purchases return and sales return. Suppose Suresh sold goods to Ramesh for Rs 60,000, of which Ramesh returned goods worth Rs 8,000 to Suresh, of whatsoever may be the reason. Now let's study the effect of returns from Suresh's and Ramesh's point of view. For Suresh, sales is Rs 60,000, sales return Rs 8,000. Then how much is the net sales? See, net sales is equal to total sales less sales return. Therefore, net sales is equal to Rs 52,000. Similarly, for Ramesh, purchases is Rs 60,000, purchases return Rs 8,000. Then how much is the net purchases? It is total purchases less purchases return. Therefore, net purchases is equal to Rs 52,000. Stock. Stock is also known as inventory or merchandise. Stock is the stuff a business has for sale or to use in making other things. It could be of raw materials, semi-finished goods, or finished goods. Stock is of two types, that is, opening and closing. Opening stock is what's unsold at the beginning of the current accounting period, and closing stock is what's unsold at the end of the current accounting period. For example, if stock of goods worth 10,000 lies unsold at the beginning of current accounting period, that is 1st April 2023, that stock is opening. And if stock of goods worth 5,000 lies unsold at the end of current accounting period, that is 31st March 2024, that stock is closing. Assets. Assets are the economic resources owned by the business that are expected to bring future benefits. They hold monetary value. That's why these are economic resources. Think of assets as the valuable possessions a business has, whether physical, like machinery, furniture, land, or non physical, like copyrights, patents, etc. Liabilities. Liabilities are the financial obligations, that is, amounts owed by a business to outsiders. This could be for goods, services, or borrowed money. It's a result of past transactions like buying on credit or borrowing cash, etc. Equity. Equity is about ownership claims against the assets of the business and understanding who holds a stake in what the business owns. There are two main types: owner's equity, which belongs to those who have invested in or own the business, and outsider's equity, which represents the claims of external parties. Owner's equity is called capital, outsider's equity is called liabilities. The basic accounting equation incorporates them as assets is equal to owner's equity plus outsider's equity. Expenditure. Expenditure is just like a business's spending plan. It is the money spent or the responsibility taken for something valuable received. These are of two types: revenue expenditure, capital expenditure. Revenue expenditure. It is for day to day stuff like purchase of goods or services consumed in current period. These are recurring in nature, that is, these are done continuously. Capital expenditure. It is for big investments like purchase of assets where value is derived in future. These are non-recurring in nature, that is, these are not done on continuous basis. Expense or cost. This is like the part of the spending plan that's already done its job. An expense is the money spent on things like salaries or advertising that contributed to earning revenue. It's the cost of goods and services used up during the current period. In simple terms, it's what is no longer with us in terms of money, but played its role in the business journey. That's all for this video. If you found it useful, give it a like and share it with others. And please subscribe to my channel. Press the bell icon to get notified for future updates. Until next time, keep learning and growing. See you in next video.